Welcome to FX Street. It is Tuesday, August 24th, 2010. Welcome back, one and all. Great you could join us here. My name's Rosen. Very happy to be here today with a fun topic as usual to talk about. We're going to talk about fundamental analysis before we get started, and I really do have a lot to cover. And I want to try to squeeze as much good stuff in as possible. But before we get to the fundamental analysis, fundamental basics to be specific, I want to give you a quick look, and Ed hit the nail right on the head. I think we do go lower on these yen crosses led by the dollar yen. We're looking at right now the Dow Jones Industrial Average Futures 10,043. I have the sneaking suspicion that this is only the beginning of something much, much bigger to the downside in terms of the yen crosses and in terms of the Dow, because we have the confirmation. The Dow Jones Industrial Average at 10,045, you know, we hit highs yesterday, 10,282, but just the other day, well, just the other week, we are almost at 10,700 on the futures. The cash market was above 10.7, which, by the way, represents a neckline of a massive possible head and shoulders pattern. And head and shoulders, again, that triple top where the center high is always higher than the first or second shoulder. Head and shoulders are known to break in the opposite direction of the head to the top. Now, it's true, we do have the potential of an upside down head and shoulders, so we will not know for sure until the Dow breaks above 10.7 or below 97, 97.50. However, if and when that happens, it will be confirmation that head and shoulders. My suspicion is because the yen crosses have just broken down to new multi-year and in some cases multi-decade lows, I have the suspicion that we're going to see the Dow move in the same direction. Typically, we see the yen crosses led by the dollar yen move in the same direction as the Dow Jones Industrial Average, because when there's optimism in the market, when things are good, we like to take a little bit more risk. Well, we buy higher yielding currencies or we buy Dow Jones Industrial Average stocks. However, when things look scary, we sell our stocks and we buy bonds. We sell our high-yielding currencies and we buy our low-yielding currencies. And specifically with the dollar yen, which I think is the center of this entire relationship, there is an enormous amount of capital investment that comes out of Japan that historically has very low interest rates into the U.S. dollar and into other currencies when there is the perception we can make money by buying stocks. So if the stock market looks good, investment capital comes from Japan overseas, comes into the U.S. stock market. But in order to buy U.S. stocks, we need to buy these stocks with U.S. dollars. And that's why we would buy dollars, or that's why the Japanese investors would buy dollars and sell yen. Hence, the dollar yen goes up. This is the opposite. When it looks like the stock market's going down, when there's a negative or pessimistic sort of cloud around the market, and there's a perception that the market's going to go down, certainly looks that way right now, we sell our stocks. And a lot of times those funds are repatriated back into Japanese yen. So we sell our dollars back and we buy Japanese yen. Where the dollar yen goes, the other yen crosses usually go. Take a look at the dollar yen. Oh, by the way, just to go back to the Dow Jones Industrial Average, by the way, the neckline we said is at around 10,700, just a little bit below. The shoulder line, which is the bottom of the head and shoulders, excluding this one really deep dip, goes down to 9,700 area. Now, where is a possible price target? Well, we take the shoulder line to the next line, 9,700 up to 10,700. That's 1,000 points. I like to take that. I've never read this anywhere, but I just sort of started using it. I think a friend of mine showed me, and I just continue to use this approximation for a price target. It works pretty well. You take your shoulder line, bottom of the head and shoulders. You take the neckline, which is the top of the head and shoulders, obviously excluding the head. That's why I did not include the head at the bottom of this possible upside down head and shoulders. The difference between the two is 1,000 points. Take 1,000 points and subtract it from the shoulder line, and it gives us our first possible price target. We certainly could go lower, but 10.7 to 97 is 1,000 points. 97 minus 1,000 gives us a Dow Jones Industrial Average price target of 8,700. We could go lower. Take your Fibonacci lines, by the way, from the top of the head and shoulders to the bottom of that upside down head and shoulders. That 8,700 represents almost exactly a 50% Fibonacci projection level. Makes a lot of sense why the market could go down. That's why I say this is just the beginning. Question is, this should not be a head and shoulders. Previous head and shoulders failed. Well, it did not if you're referring to the big head and shoulders, I would not consider that it failed. It's sometimes these patterns just, I think, take a little bit more time to develop. But overall, if you put aside for the moment that a theory is that it is a head and shoulders, let's not identify this. What we can say is that the market is making lower highs. We were at 11,200, 11,100 going back to the end of April of this year. And that was after hitting lows of 10,100, 10,200. Well, actually, I'm sorry, around 10,000, 99.50. The market made higher highs to 11,100, 11,002, but then made new lows. Then we went back up and we made lower highs, we made lower lows. Overall, going back, easily to the end of April, the market is giving us a pretty negative picture. We're making lower lows, making lower highs. Fundamentally, which is what we're going to get involved in a minute, there's certainly a lot of ways to explain this. And it's actually very, very interesting what has developed. Here's the dollar yen at 84.01. We hit lows earlier today of 83.71. How long has it been since the dollar yen has been down at 83.71? We'll have to go all the way back to 1995, lows of 79.75. That is huge. Where the dollar yen goes, other currencies go, other currency pairs go as well. Take a look at the euro yen. Huge breakdown. 105.90. Euro yen was stuck in nowhere for the longest time. Past 2 days, it seems the market all of a sudden just woke up. Not a coincidence. We're leaving this quiet August trading season and we're entering September. And then October September we have a lot of big economic pieces of news. October, we have earnings season. October is definitely one of the most volatile months of the year. I'd say July is number one, tied with October for number one or two. And then we have November congressional elections in the U.S. A lot of uncertainty. Democrats versus Republicans. Who will take charge and what will that mean to the economy, which is headline news. Euro yen broke 107.31 lows of June 29th. Euro yen, remember dollar yen 1995 levels. Euro yen, I have to go to a monthly chart. Going to a monthly chart on the euro yen, we're looking at levels that we have not seen since June of 2001. And the next lowest low, significant low, 88.87, October of 2000 lows. That is huge. Cable yen, notice, has not broken below the lows May 20th of this year. Aussie yen, weaker, definitely over the past couple of days. We have not even broken the lows of July of this year. Nor has the Kiwi yen. Well, we're almost back down to the May 25th lows. CAD yen has really broken 78.84, challenging levels we haven't seen since late April. But dollar yen, 1995 lows. Euro yen, 2000, 2001 lows. Follow those pairs that break first. I'd like to exclude the dollar yen because it's a hard currency pair to trade. But I'm guessing if the yen crosses continue lower, euro yen is going to lead the charge lower because it broke first and because we're already so much lower. Let's take a look at some of the fundamentals though. Take a quick look at the economic calendar. We have a 10 a.m. Eastern. This is the FX3 economic calendar, by the way. We've had Purchasing Manager Index figures yesterday. Today we've had GDP numbers, not huge numbers though. The big numbers, retail sales in Canada and 10 a.m. Eastern, existing home sales. Now the housing market in the U.S., certainly in the UK as well and other places, has not been strong, quite the opposite. Homes are at unbelievably low prices. 30-year mortgages are at all-time lows. I think I heard 442 the other day. We have Richmond Fed Manufacturing Index today as well, by the way. The market's expecting bad numbers. But if the numbers are a disappointment, I think it's going to give the market a really good excuse to go a lot lower. We have interest rate decisions, by the way, right around the corner as well. I want to get to the fundamentals, but because you brought up commodities, I want to address them because there's a very important point. Sometimes gold goes up when there's a fear of pessimism in the market, and sometimes gold goes down. The fact of the matter is the dollar is going down, and there's a lot of other currencies going down. You would think, logically, gold should go up. But then again, we take a look at currencies like the Aussie and the Kiwi, which are commodity-based currencies. These currencies, like the commodities, tend to do well under good economic conditions because the Aussie and Kiwi have higher interest rates. The same note, when there's growth in the economy, we're going to talk about CPI and the inflation numbers. We're going to talk about GDP numbers and the growth numbers. Let's pretend for a moment the economy is really strong. Well, we want to take some risk when, go out there and invest in the economy. GDP numbers move up and things get more expensive, things get more inflationary. What do we buy to fight the fear of inflation? We buy the one financial instrument that can compete with inflation. That's gold. Because as things get more expensive, those airline tickets and baskets of goods and services get more expensive, our dollars or euros, whatever currency we use, kind of loses value. Because if we have to pay a little bit more for a flat screen TV or an airline ticket, or with the same dollar, well, the dollar has a little bit less buying power. That's inflation. Federal Reserve has to raise rates, interest rates go up, and the dollar begins to appreciate. The dollar follows the economy up. However, when there is not the fear of inflation, when there's a risk of deflation, the price is going down because growth is slowing down. And these inflationary numbers are now deflationary. Well, then we don't need gold because we don't have to fight inflation that doesn't exist. We look at safety. And I think that's why currently you see gold and other metals move in the same direction as these currencies. Crude oil, I think you can consider under the same light. 71.94, by the way, crude oil futures. Breaking below a support line. When we believe the economy will improve, that's more manufacturing, more vacations, airline tickets. We're going to buy big cars and use a lot of gasoline. We buy crude oil. When there's a fear of a recession, when it looks like things are getting worse, we cut back on our spending. Businesses cut back on their manufacturing. We cut back on airline tickets and summer travel, etc. Oil goes down. Let's get to the fundamentals. I think it's very important to watch the commodities because they can certainly be a forward-looking indicator which breaks first, gold or commodities. Now, following chart we're looking at, and please let me know at any time if you can't see these charts. However, the following chart we're looking at is something I've created. I like to keep track of these economic numbers. The chart represents the number one reason why foreign exchange moves, why currencies move. It's the anticipation of higher or lower interest rates. Assuming there was no news out there at all, and everything was status quo, and I could take my savings and invest in Australia and make 4.5%, or invest in Japan and make 0.1 of percentage points, or in the U.S. and make almost no interest. Well, if there was no other conditions that applied, I would certainly want to put my savings into a higher yielding savings account or buy higher yielding bonds and CDs in Australia, higher yield. However, if there is the fear that we're under some sort of economic recession, that things are going to get worse, things are in the process of getting worse, which central bank can cut rates? A lot more. Australia? Definitely. New Zealand? Number 2. Australia, Reserve Bank of Australia, by the way, which is that dark blue line, the RBA, they're 4.5% interest rate. They could cut down to 0. The yen, the Japanese yen, 0.1% interest rate, they can also cut down to 0. The Aussie is a lot further to fall down. That's why when things are good, we know we like to buy the Aussies and the Kiwis, that's the red line, the New Zealand dollar, because we earn more yield, and it's safe to do so, because there's very little risk the central bank is going to cut rates. The same way why I want to invest in California bonds only under good economic conditions, nothing against California, but I think California state bonds have I don't think they will, but they have a much better chance of defaulting than I believe I heard on the news today that Virginia actually has a budget surplus. Is that correct? Well, during economic turmoil, anybody from Virginia? During economic turmoil, the bonds have a greater risk of defaulting. That's why I want to buy safety when things look bad and buy speculation, buy possibility of making money when things look good. And that's why the Aussie really goes down and the Kiwi goes down. Why is the euro yen down more than the Aussie yen on a point-to-point basis? Well, there are specific conditions that occur that exist within each economy. That's why it's not always a straight line. But this is the basics of the foreign exchange market. We're always, as traders, as participants in the market, we're always trying to guess the next step. Will the economy be more optimistic? Will things get better? Will things improve? Let's buy higher yielding. But then we have to ask ourselves a question. Which economy has the best chance to improve sooner? Let me put the question out to all of you. We have 5 or 6 very big central bank meetings that are scheduled for the next 30 to 45 days or so. which central bank do you think is most likely to raise rates? I don't think any central bank will cut rates. I think we're very, very close to the bottom and we're on the way up. So far, the central banks that have already raised rates, Reserve Bank of Australia, Reserve Bank of New Zealand, and the Bank of Canada. Which central bank is most likely to raise rates? Which is least likely to raise rates? I'll put that question out to all of you. I'll give you an answer as far as least likely. The Bank of Japan, they're an export-driven economy. They like low rates. What is the dollar yen, by the way? What kind of mood does the dollar yen at these levels at 8,400, 8,300? How does it make the Bank of Japan feel? Not very good. The Bank of Japan does not like the dollar yen this low. It does not like the euro yen down this low. The Japanese economy, we talk about this all the time. It's an export-driven economy. The stronger the dollar is against the yen and the stronger the euro is against the yen, the more goods and services that U.S. and European consumers can buy from Japan. The Japanese economy does better when the euro yen is higher, when the dollar yen is higher. Right now, as a U.S. Consumer, if I want to go over to Japan, my dollars do not have as much buying power. I'm not buying as much. That's not good for the Japanese economy. So, Bank of Japan loves to keep interest rates really low. In fact, take a look to see at the highest high Japanese interest rates were back in the peak of the peak, 2007, 2008, before the crash. The Japanese interest rates were only 0.5%. Reserve Bank of New Zealand rates, 8.25%, I believe, were the rates up there. I believe 8.25%. Reserve Bank of Australia, not too far below. Yeah, 8.25%. Now, the question is, which central bank is most likely to raise rates once this downturn is over, once things eventually get better? I find it hysterical. A friend of mine sent me an article earlier today. I forget which bank published this report. There was a report that was published saying that the housing market, buying homes in the U.S., apartments, condos, the real estate market is a market that they basically said it's not going to be a good investment anymore. Very open-ended, the article said. Now they said, well, maybe not forever, but we cannot expect to see house prices go back up. House prices are down. They're probably going to go down further, and they're probably not going to go up. There's just lack of fundamental reasons. They cited different reasons. One of them was the baby boomer generation, which obviously bought and owned and built an enormous amount of homes, and we will not need that surplus of homes in the years to come. Because we forget about population growth. That was one of the reasons they cited. They also said, I found this hysterical, they said, okay, interest rates in the U.S. are very low right now. The number I heard was 4.42%. Seeing 30-year mortgage is actually less than that. I think 4.5% were the all-time lows before now. Now, they said interest rates are low. And when the economy improves, the Federal Reserve will raise rates. And when they raise rates, that's going to slow the economy down. And that's going to crush the housing market even further. I wish I could remember which bank had published this report. I have news for them. I don't think the Federal Reserve is going to raise rates anytime soon. I don't think the Federal Reserve will raise rates until and only after the housing market recovers. Federal Reserve, like any central bank, when they raise rates to control the expectation of inflation. There's really no inflation. We have deflation on our minds right now in the U.S., as well as many other places. The fact of the matter is, yes, they are correct when they say when the Federal Reserve eventually raises rates, that will be a depressant to the housing market. But I think in order for higher rates, what are high rates that could actually have a serious impact on the housing market? I think you're talking about interest rates in the U.S. 3, 4, 5.25%, where we were 5.25%, where we were a couple of years ago. I don't think if the Federal Reserve raises rates from 0 to 0.25 to 0.5%, that's not going to crush the housing market. And I cannot envision the Federal Reserve is going to raise rates anytime soon or that aggressively until the housing market and the jobs market certainly tells us it is time to do so. But going back to our question, why do central banks raise and lower interest rates? Well, they watch the market. They watch not the market, but they watch the economy. They watch its economic indicators. I remember hearing a long time ago the former Federal Reserve Chairman Alan Greenspan, he used to watch something along the lines of 200 different economic indicators. I watch 5 or maybe 10. Imagine watching 200 different indicators, trying to gauge whether it's the appropriate time to raise or lower interest rates. And of course, these rate hikes and cuts, they're usually not drastic, a quarter point here, a half a point there, spread out between 4 to 6 weeks at the most. But the fact of the matter is, these little changes in interest rates certainly have an impact. But if I want to answer the question, and the reason why I want to answer the question of which central bank will raise rates first is because if we have interest rates at 4.5% in Australia right now, and I have a very good suspicion that the economy in Australia is really going to continue and explode to the upside, and I think before you know it, interest rates in Australia will be 5-6%. I want to buy Australian dollars now because the market's a forward-looking mechanism. The Aussie currency will go up before interest rates in Australia go up. I actually have a comparison for you. So I want to buy ahead of the interest rate hike. Now, if you take a look at the chart, remember the lows going back in the Dow Jones Industrial Average? That was March of last year, right? February, March of 2009 were the lows of that huge market crash in the Aussie yen, the Kiwi yen, also stock markets. Well, take a look at this. The Reserve Bank of Australia, April of 2009 was at 3%. They did not raise rates. September, October was the first time the Reserve Bank of Australia raised rates from 3% to 3.25%. Remember that, October 2009. Let's take a look at the charts. I want to show you how much sooner the markets hit a bottom and then turned around. Looking at the Aussie and daily chart, we said October of 2009. Zooming out, remember that huge move lower? Remember we hit those ultimate bottoms? Aussie yen hit a low of October 2008. And actually, the double bottom, if we missed the first one, February of 2009, the Dow Jones Industrial Average hit the low around March of 2009. Reserve Bank of Australia did not raise rates until October of 2009. Let's draw a vertical line to show you. This is October, given the benefit of the doubt. October 1st, 2009, Aussie yen was at 80. The double bottom occurred at 56, 57. Therefore, if we had waited for the Reserve Bank of Australia to raise rates before buying the Aussie yen, we would not have made as much money and probably would have lost money. Look at the Reserve Bank of Australia or the Aussie yen now, 74.11. But if we had purchased based on the anticipation that the economy would improve in Australia, because ultimately Reserve Bank of Australia makes their decisions based on the economy. So it behooves us to watch the Australian economy so we can anticipate when the Reserve Bank of Australia raise rates. After all, these rate hikes that occur, it's usually the last element to occur. Showing you now the chart. The Canadian dollar, Bank of Canada, the Bank of England, two possibilities. If I had to close my eyes, we're going to take a look at both currencies. If I had to close my eyes and guess, I would guess the Bank of England before the Bank of Canada, but it's a close tie. We're going to take a look at both. What we're looking at right now is the unemployment rate in Australia. The economy was very, very bad. Unemployment went down. That's the blue line, by the way. The violet line represents the 12-month moving average. I like to use 12-month moving averages because, well, you know, these are monthly numbers, monthly unemployment numbers. Might as well look to see how it looks in comparison to its own 12-month average. What was the ultimate low? Remember, the Reserve Bank of Australia did not raise rates until October of 2009. The bottom of the markets, the bottom of the Aussie yen currency pair was October 2008 to February 2009. Remember, we had a double bottom pattern. Take a look at the lowest low of the unemployment rate, February 2008. Unemployment actually bottomed a year before the market bottomed, and about a year and a half before the Reserve Bank of Australia raised rates. Well, the unemployment rate obviously going down. Now, unemployment rate going up. That is when we hit our all-time high. Now, an all-time low in the Aussie yen chart, unemployment all-time high, 5.8%. In the U.S. here, we're at 9.5%. In Europe, I think we're right around 10.1%. October 2009, unemployment hit all-time highs, 5.8%. And it started going down. And in fact, crossed below its own 12-month moving average, December '09, January 2010. Remember, Reserve Bank of Australia raised rates for the first time October of '09. Well, where were we October of '09? Unemployment had just started to come down. That was at double top on the Aussie unemployment rate. Obviously, the Reserve Bank of Australia was anticipating, not only watching the unemployment numbers, we don't know if the unemployment number was a little bit ahead or behind Reserve Bank of Australia making their decision. Reserve Bank of Australia makes their decision not only based on unemployment, but on a slew of different numbers. So they take basically the average of all their different readings and say, okay, now is the time to start raising rates. But the economic conditions will improve before the central banks start to make their moves. In fact, this little blip down probably constitutes the first sign of a little bit of improvement, although we did hit a little bit of higher high. We can compare the Reserve Bank of Australia, Reserve Bank of Australia, by the way, that's the blue line, to the unemployment rate in Australia. That's the violet line. We can see the inverse or opposite correlation, that when the Reserve Bank of Australia cuts rates, it is a result of unemployment going up. Unemployment goes down, Reserve Bank of Australia decides to raise rates. Notice lately, unemployment rate in Australia has started to tick back up. I don't believe that will lead the Reserve Bank of Australia to cut rates. I don't think so, unless things get really, really, really bad. But assuming they don't get very, very bad, I think this means the Reserve Bank of Australia will not cut rates. They will not raise rates. They're going to stay put. Well, there's not a lot of uncertainty. There's not a lot of possibility we're going to make more money. Why do we take the risk? However, if unemployment drops, especially below 5.1%, which is the lowest low we've seen since February of '09, if you see Australian unemployment, unemployment, I should say, under 5%, I think we're going to start to see some strength in the Aussie currency, because that certainly increases our probability that we're going to see higher rates in Australia. We can compare the unemployment rate, that's the violet line, to the ASX, that's 200. That's the stock market in Australia, one of the indices. Generally speaking, unemployment goes down, stocks go up. Unemployment goes up, stocks go down. Equal comparison. That is Australia. We can also obviously take a look at the other economic numbers. I like to watch employment very, very closely in Australia. By the way, speaking of employment, compare the unemployment rate, the violet line, to the Aussie dollar currency pair. Now, of course, there's two currencies within a pair. This doesn't tell us what's going on with the dollar. But generally speaking, unemployment goes up, Aussie goes down against everything. Unemployment goes up, or I should say unemployment goes down, the Aussie goes up. Unemployment, if we drop below 5%, I think we see strength in the Aussie currency against the dollar, against other currencies. But if unemployment rises, especially breaks above that 540 level, 5.4%, those are the highs of April 10th. If we start to look at highs we haven't seen since December of last year, that should not bode well for the Aussie currency from a fundamental point of view. Of course, once we have this opinion, then we can look to the charts and discuss technical analysis, support, resistance, Fibonacci, current trends, etc. But I always like to start from a fundamental point of view. Just shows us, looking inside the economy, how is the engine running? Is it running smoothly? Well, I think one of the economies that has a really good chance, and you did mention this, Harley, one of the economies I think that has the potential, don't see great things right now, but has the potential to do a lot better, is the Bank of England and the UK economy. The new government has really led the charge in cutting costs, in cutting the deficit. I think that the U.S. Economy could certainly learn a lesson from this in cutting our own deficit, our own budget, so to speak. That leads to stronger pounds. That leads to a stronger currency. We want to see countries and economies that are able to generate a surplus. It means that currency is going to improve. It means that that central bank is not going to have to print more money. The big argument against the Federal Reserve in the U.S. printing so much money is the fact it's dilutive. Every time we have a stimulus plan, some sort of new bill that requires another billion or trillion dollars, that means there's that many more U.S. dollars circulating in the world, and that means that we need that many more U.S. dollars to buy the same euro and to buy the same pound and all these other currencies. It's dilutive. We don't want to see that. That leads to a very, very weak currency. And I think that's why, I read an article the other day, an economist projected it said the U.S. dollar is on its way to move in the same direction, or in the same area as the Argentinian peso, which does at times experience tremendous amounts of depreciation, tremendous amounts of dilution. Question is this unemployment rate data correlation to be useful in U.S. data? Absolutely. We're going to take a look at the U.S. dollar. We do have a lot of numbers to watch in the U.S. dollar. What we're looking at right now, by the way, is the Bank of England historical interest rates, currently at the 0.5% level. We can compare it to the FTSE, the stock market in the UK. As times are good, we tend to see higher stock prices. Bank of England raises rates. And when times are not so good, we see the Bank of England cut rates. But specifically, there are two components to the economy as far as the way I look at the market. Everybody has a little bit of a different view. I like to dissect the market into two categories. We talk about the market meaning the economy. We talk about the economy in terms of growth and in terms of inflation. We start at the beginning and I get a new job and I make a lot of money. And I go out there and I go to the stores and I start spending money. And those stores start to have higher earnings because I'm buying so many great things. And those employees start making more money because they can afford to, because the store can afford to pay them more. They get bigger bonuses, and in turn they go out to different stores and buy lots more goods and services. Well, there's a higher demand for these goods and services, so these companies and these stores, they say, well, things are great. We're selling a lot of flat screen TVs because everybody's working. Let's raise prices a little bit. Why? Because people will pay the prices. That's okay without making a lot of money. So the prices go up. That's inflationary. All of a sudden, my U.S. dollar doesn't have as much buying power because everything goes up a little bit in price. Federal Reserve, Ben Bernanke says, Adam's dollars doesn't have as much buying power. Let's raise interest rates a little bit to make the dollar a little bit more attractive to foreign investments. And that will bring in foreign capital to buy our dollars. The opposite is dilutive. It's going to condense the power of the currency. And the next thing you know, my dollar appreciates and I have more buying power. I have more buying power and the economy heats up. House prices go up. Everything's great. Eventually the economy overheats and moves to the downside. However, when we talk about those prices, we talk about inflation. How much more it costs us to buy something now than it did a couple of weeks ago or a couple of months ago. Talk about inflation, the two big numbers I watch is the blue line here, the CPI, Consumer Price Index, which measures a basket of goods or services on a consumer level. We can also talk about the PPI, the Producer Price Index, and it measures that same basket of goods or services, but prior to the consumer level, how much does it cost the producer to make? And the opinion out there is that if the producers have to pay a little bit more, they're going to pass those extra costs on to the consumer. So if you see the PPI go up, chances are you're probably going to see the CPI go up as well. The CPI and PPI, Consumer Price Index, and the divided line, by the way, the 12-month moving average, is a cyclical number. We're not going to see tremendous trends develop unless we see really, really trendy economies. Take a look at the CPI, 5.2%. That was a high September of 08. The next thing you know, we all got in trouble. The economy crashed, and we said, we don't have any more money to buy things. And prices came down. The Consumer Price Index came down, hit a 1.1% level, eventually moving back to the upside. 8-1, Andrew Sentence, who is a member of the Bank of England, has voted. He's been outvoted 8-1, 7-1 last time. This month they said 8-1. I don't know why. 3 months in a row, 3 central bank meetings in a row, Andrew Sentence has been the one individual that has said, hey, I think the Bank of England should raise rates. Why? His number one reason, inflationary pressures. He said, hey, CPI, 1.1% September of 09 has just peaked on April of this year at 3.7%. We're above its own 12-month moving average. I'm sure he's not looking at the 12-month moving average. However, he says inflation has increased. It's time for the Bank of England to raise rates. We can compare the CPI to the Bank of England. Bank of England historical rates, by the way, that's the violet line. During prosperous times, Bank of England had pretty significant rates, 5.75%. Take a look at the CPI, back to the upside. Sometimes it's the leading indicator, sometimes it's the lagging indicator. Question is, also I think the pound will be stronger than the euro given all the problems. Yeah, I would certainly agree with you that between the budget shortfalls and the enormous issues that have gone on in Greece Spain, Portugal, Italy, most of Western Europe, excluding Germany, for the most part, that I think is going to allow the pound a lot better chance of higher rates sooner than the euro. The euro has issues. Now, question is, so are you long-term trader or short-term trader? Which do you feel better in these times? Well, if you were to ask me, it's a great question. I see the dollar is up against the cable. As the cable goes down, the dollar acts as a flight to safety. I think you'll see, by the way, for the previous comment, that the pound is down a lot more against the yen. Because in the past, and I really, there's so much to talk about. I don't want to skip over anything important. When stock markets go down, such as this morning, we tend to see the lower yielding currencies like the dollar and the yen and the Swiss go up. But the dollar really isn't participating because we have our own issues in the U.S. and we don't know necessarily if because of this all this additional spending, the dollar really does represent the best currency as a flight to safety. That's why I think the yen is very, very strong compared against the pound and the Aussie and the euro and everything else. And the dollar is a little bit stronger than the rest, not as much as the yen though. In other words, I think that the trade is you're going to see the euro yen go down a lot more than the euro dollar, and the pound yen a lot more than the pound dollar. Now, to answer your question, I think the best way to trade the foreign exchange market are long-term positions. You take a very small position with a very wide stop and try to capitalize on these very long-term trends. Reason being, well, I'll tell you my personal reasons. Before I became involved in foreign exchange years ago, I was a day trader, stock day trader. Now, stock day traders, they get a certain amount of capital and your company tells you to go out there and try to make money. But you have to close your position every day before the market closes at 4 o'clock in New York. Can't hold overnight positions because the stock that closes at 50 could open up at 10 and the stock that closes at 10 could open up at 50. You never know. And you can wipe out your money and the firm's money. So the rule is you have to close your positions by the end of the day. The number one reason why I became attracted to foreign exchange trading is because you don't have to close the position. You place your stop order, and you know when markets in New York close, they open in Japan. And when they close in Japan, they're already open in the UK. It's a continuous market. So there's really no chance, very, very small chance of a gap that the market's going to open at a different price than the close. Much more safety. And that you can capitalize on these long-term trends. Short-term trading, yeah. I mean, there are specific, I think, times to do so, but you gain a much better risk-to-reward ratio, and I think the potential profit over the long term is much, much greater. And if you trade in the same direction as a carry trade, meaning you buy the currency with the higher yield and you short the currency with the lower yield, you can also make a little interest along the way. These times, I think, we're right in the beginning of what could be a huge, huge move after a very, very quiet August. So if we're in a position, I think it certainly behooves us to hold on to at least a small piece of it. If it's making a little bit of money now, my guess is if you're short something, short the euro yen, pound yen, etc., if you're making a little money now, I think you're probably going to make a lot more. Now, getting in the position, the entry, the stop order, the position size, that separates the winners from the losers. Picking the direction of the market, I think is fairly simple. It's either up or down, right? Managing the trade. Playing the role of a risk manager as well as a trader, actually finding the right position and finding the right spot to place a stop order. That really takes the skill. That separates us. Separates those of us that can and cannot make money. And certainly I'm on one side of the coin sometimes and on the other side of the coin other times. Now we expect the euro dollar reversal around 25.30. I don't think the euro yen will follow back up. I think the euro yen, look, if the market starts to recover, certainly eventually we're due for a bounce. I don't think we're going to go straight down. But I would not want to buy the euro yen under any circumstances. If the euro yen goes up 300 points, 300 pips, I still don't want to buy it. Because my long-term fundamental opinion is that the euro yen and the yen crosses are going to continue to go lower, led by equity markets and led by economic conditions lower, so the probabilities are not my favor. You know, the wind is blowing from east to west. I could sail from west to east, but chances are I'm going to have a lot more difficult time accomplishing that. I don't want to drive down the wrong direction on a one-way street. I could get away with it, but if you do it enough, eventually we're going to get in trouble. Greenspan said he favored inventory data, which are indicators for inventory data. What does Ben Bernanke's favorite indicators? I wish I knew. If you can't see the charts, by the way, please let me know. I just refreshed the charts. I'll be more than happy to refresh them if you can't see them at all. Inventory data, we look at the manufacturing numbers. I think, I'm not 100%, I think when Alan Greenspan refers to inventory data, I think we look at the PMI numbers, the PMI services numbers, and we look at the individual manufacturing data. That is, I mean, I like to pride myself on having a good basic grasp on fundamental analysis. Alan Greenspan, Ben Bernanke, and the like are eons away from, above me, so to speak. So, you know, whatever they say, I would certainly place a lot more credence with. But hopefully, you know, with this webinar, which we'll be able to provide a little bit of a basic idea of what the central banks use, what are the biggest numbers that the central banks may use. Now, talking about the UK economy, before we get to the others, we look at the unemployment rate above its own 12-month moving average, 7.9% after peaking at 8%. Again, U.S. unemployment is at 9.5. Australia is near 5. Euro is around 10, I believe. So comparatively speaking, unemployment is not that good. We see inflationary numbers starting to improve. Remember, there's two sides of fundamental analysis as far as I'm concerned. Inflation, CPI is starting to look a little bit good in the UK. Unemployment and the growth side, not so much. Now, let's talk about Canada. Bank of Canada is one of those only three central banks to raise rates in the recent past. And in retail sales, by the way, Canada are due out, probably already out. In fact, they are out. This is the CPI, Consumer Price Index in Canada versus its own 12-month moving average, currently 1.8% above its own 12-month moving average. Historically, we have recovered. CPI in Canada looks better than most, I would say. The blue line represents the Bank of Canada interest rate, 0.75%, off those lows of 0.25%. Compare that to CPI. Generally speaking, remember CPI is very cyclical. We see a lot of up and down, up and down, up and down. But when the CPI goes up, Bank of Canada tends to raise rates. CPI goes down, Bank of Canada tends to reduce rates. CPI currently, by the way, is at 1.8%. The breakout would be at 1.9%. In other words, we want to see Canadian CPI above 2%. Above 2% will put us at levels we've not seen since December of 2008. I like to apply technical analysis breakout ideas to fundamental indicators. Fact of the matter is, if CPI goes to 2% in Canada, it'll be levels we have not seen in a year and a half. Certainly would bode well. Now, let's talk about U.S. data. I have a lot of news to talk about in terms of U.S. data. We can compare U.S. data. The real issue, I think, with the U.S. dollar and the U.S. economy, and I'll find one chart. I'll find one chart. This is it. That really paints the picture. The blue line represents a dollar-Swissy currency pair. The violet line represents U.S. GDP. GDP, by the way, is the other one big number I like to watch in terms of measuring the economy's growth. Gross domestic product. It's released on a quarterly basis, but we have monthly revisions, the preliminary, the actual, and a revised number. So we get GDP, snapshots of the GDP every month. Now, U.S. GDP, the highest high that we hit was 8%, August of 2000. The dollar-Swissy, hold on to your seat, around that time was just about 180. 179.66 was a high, October of 2000. That was the strongest that we've seen the U.S. economy perform going back at least in 1990, which is far back as my data goes. Frankly, I don't know if it's ever been stronger than that. If anybody has data on the GDP going back before 1990, I'd love to know. But 8% is what the economy, the U.S. economy was growing at in August, I should say, of the year 2000. By the way, everyone is familiar with the $13 trillion, almost $14 trillion deficit that the U.S. has. Well, I heard recently a statistic on the news. They said that if the U.S. economy grows at 8 to 10%, I believe is the figure, 8 to 10%, sorry. If the U.S. economy grows at 10% a year for the next 10 consecutive years, from 2010 to 2020, that would allow us to erase our budget deficits. The highest that the GDP has been going back at least 20 years and probably a lot more is 8%, meaning we have to go back and surpass the highs of the best days of the year 2000 for 10 consecutive years. And that will take our budget deficit away, our $13 trillion budget deficit. Now, the likelihood of that happening, not so good. That is why GDP will cycle up and cycle down. When the GDP goes up, the dollar goes up. When GDP goes down, the dollar goes down. But look what has happened. GDP goes up, the dollar doesn't go up as much. GDP goes down. Take a look at where GDP was going back down to June of last year, 2009. Negative 6.4%. Remember the stock market crash in 2001? The GDP hit levels of negative 1.3%. That is how much worse things are now than they were in 2001. That is because in 2000, stock market bubble that crashed, that burst, it was made up of tech stocks. It was made up of, well, things that the economy really didn't need before. Although they made life easier, it was not the staple of the U.S. economy. What led to this crash, this economic recession, depression, whatever you want to call it? Well, really, the essence of the U.S. economy. Banks, automakers, homes. Those three, and of course, retail sales and everything else, right in the middle of the U.S. economy, that is where it hurt the worst. Why does the dollar not go up when GDP goes up? Take a look at this. GDP went from negative 6.4% to most recently 5.6%. The dollar did not go up. It's the spending. The more stimulus plans that are created, the more money that is printed, the more the dollar is diluted. The less buying power those dollars have. Therefore, dollar really doesn't want to go up. After all, why buy the dollar if there's just that many more of them out there? It's like that toy during Christmas season that everybody wants and nobody can get for the next year. The shelves are stocked full of them. The reason why we wanted the toy is because nobody has them. However, everybody now has dollars, and that's why the dollar continues to be so weak. Question is, what would the long-term effect of dollar printing be on inflation? You read my mind. It was my next point. A lot of economists, I hate to be such a pessimist, but the writing's on the wall, I think. A lot of economists say this could lead, first we see deflation, which is now. Prices are down. Airline tickets are cheaper, computers are cheaper, everything's cheaper. But eventually the Federal Reserve has to raise rates because eventually the economy is going to recover. But the economy recovers, but yet the dollar doesn't want to go up because there's so many more dollars out there because we've printed so many. So we have more dollars out there, which is inflationary, and then prices go up, and that's inflationary. It's called hyperinflation. It's when prices go up at the same time that our buying power goes down, meaning we can buy less. But usually, when the Federal Reserve raises rates, that means that European investors and Japanese investors will say, hey, Federal Reserve raised rates. Let's buy some dollars. They're raising rates. We get a higher interest rate. But then they say, well, I'm not going to buy U.S. dollars right now. Look how many more dollars are out there. They've printed so many, I don't have to walk very far. I have to bump into a dollar. Figuratively, of course. Therefore, I'm not going to buy the dollar. So the dollar doesn't, it's sort of like a spiral snowball effect. We don't want to buy dollars because there's so many more of them out there. It's not a precious item really anymore. Well, that means the dollar loses value. But at the same time, the economy improves. Housing prices go back up. Our GDP numbers start to go back up. Things get a little bit more expensive. The Federal Reserve has to raise rates to fight inflation, leads to hyperinflation. The solution, in order for me to be bullish on the dollar, which I certainly am not these days, I think the euro dollar goes down and the pound dollar goes down. But fact of the matter is, I think that there are a lot better values out there. What do we need? We need to see, I think, more fiscal responsibility. I think we have to start to see spending going down, and we have to start to see growth compiled with higher prices, better employment, better housing market. We need to see all of that. I think it starts from the beginning. I think we need to see from the government level less spending, lower taxes, more savings. I am out of time. If you want to contact me, please feel free to do so. www.forrestbound.com is my address. I thank you all very much for joining us. Very special thanks to FX Street. By the way, please see their calendar because I'll be back on for much, much more later on. We thank you for joining us. We wish you a great day. All profitable trades. And we look forward to seeing you back.